Hello and welcome to Portfolio Matters Weekly Update, Week 36. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Take it away, Keith.
Thank you, Richard. Very swiftly done. Okay, first of all, some housekeeping. Well, we have had a donation from Andrew M of 250 quid, which is frankly amazing and very flattering and encourages Richard and I to keep going. And it took us a while to actually facilitate this, but we have now set up a bank account for the Portfolio Matters partnership. And in due course, we will be setting up a donation channel. And we hope that other viewers will feel generous enough to contribute to this podcast.
Indeed. Now, thank you very much, Andrew M.
And we have no intention of accepting advertising from YouTube because it's intrusive and annoying. But if anyone would like to sponsor us, please get in touch. The usual provisos apply. The other exciting development is that we are going to have a pub night. And Richard, Stuart and I, and another fund manager who occasionally contributes to the podcast but doesn't want us to use his name, will be in the Princess Louise pub on High Holborn on Wednesday the 29th of September at 6:30 p.m. And if anyone would like to join us, we would love to see you.
As I say, I think you're flattering yourself there, Keith.
Thanks. Okay, on to the week's developments. Well, the big news on the week was the ECB met and Christine Lagarde announced that they were going to reduce their bond purchases by an unspecified amount, but it absolutely did not amount to tapering. Make of that what you will.
Sounds like tapering to me, Keith.
Yep. Okay, economic data for the week. US non-farm payrolls came in last Friday and they were hugely disappointing. They came in at 235,000 for August, which was massively down on July and well below expectations. Now, we have a chart for you later, which will show that there were job losses in retail and no job growth in the leisure sector because of the Delta variant. And that is likely to be a transient effect, the fall in non-farm payrolls. But the unemployment rate actually fell to 5.2%, down from July, 5.4%, and below consensus expectations. So that is very good news. However, the labour force participation rate is stubbornly low at 61.7%. And we'll show you a chart of that in a bit. But US employers are looking for labour. So the JOLTS job openings is absolutely enormous. And we will show you a chart of that. And it's a high from recent memory, basically. In July, it rose to 10.9 million job openings, a rise of 750,000 on the month and well above expectations. So US businesses are doing well and they are looking to grow and to add labor. Now, in the US, consumer credit for July came in at $17 billion, which was well down on June and well below consensus expectations, but we'll show you a chart in a minute, and that is in line with the average pre-COVID. And our UK's construction PMIs came in at 55.2, which is solid, but down on July and below expectations. Industrial production in the UK in July was plus 1.2%, which is good. and a recovery from June when it fell by 0.7%, and it also beat expectations. All good news. UK GDP for July came in at a very disappointing 0.1%, which is well below June and well below expectations. In the EU, construction PMIs actually came in at 49.5, which is in contraction territory and well below expectations. Now, all the other data we're seeing is suggesting that the EU economy is doing okay. So I think this is a construction sector phenomenon. Now, we had some quarterly data from the EU. So in Q2, the quarter-on-quarter employment rose 0.7%, which is great and beat expectations. And the Q3 growth rate is estimated to be plus 2.2%, which is really good and well above Q2, where it contracted by 0.5% and above expectations. So that's all good news. Now, going through some charts. Okay, so this is US non-farm payrolls, and the August number was very disappointing compared to the previous 3 months. But I think the Delta variant is largely responsible. But the unemployment rate continued to tick down. And this is continuing in unemployment claims. This is weekly data, so we haven't included it in the table, but you'll see just a continued steady decline. Now, the job openings chart is absolutely extraordinary. So this chart goes back to 2012. If you're looking for a job in the US, you can find one. And what this chart really shows is that the economy is just doing well. If you can get out of the way, get rid of all the restrictions on movement, etc., the economy should self-heal. So why are companies finding it difficult to hire? Well, you can get a clue here from the labor participation rate, which is the dashed line. So the other two lines are various measures of employment. You see, employment is rising, but the labor force participation rate remains low. Now, I wonder whether this is caused by the fact that many people in late middle age have actually done very well from the stock market and seen their value of their assets rise since the bottom of the COVID crisis, and they now feel able to retire, in which case very easy monetary policy is actually causing economic harm and will lead to inflation as companies have to bid up for labor.
So just go back to that chart, Keith. And if you assume, I'm not quite sure what the total number of available employees is in the US, but if you assume it's 150 or 200 million, this is showing that there's about 1% difference in movement from 12 months ago, which actually only equates to maybe 1.5 or 2 million. Yet the job openings is 10 million.
Yes.
So in fact, the difference in this, the opening, the jaw opening of this graph doesn't really account for a particularly large amount of the job openings.
Yes, good point, Richard. Yeah. So something else is going on.
Yeah.
People are slow to coming back into the labor force.
Yeah.
Now, this is consumer credit, and you'll see that it ticked down from a very high number in July, but actually that is well above its average in 2018, 2019. So consumer credit is actually slowly healing in the US. Okay, now we have a couple of special topics this week. Now, the first one is the EU's fiscal stimulus plan, which it passed in 2020 to help the EU through the COVID crisis, but is only now coming into effect. Now, why are we interested in this? Well, we're interested in it because the EU has massively lagged the US since COVID. So the blue line is euro area, and the dashed line is its trend growth, and you'll see it has not got anywhere near its previous trend growth, whereas the dark blue line is the US, and it has recovered and now exceeded trend growth. So the EU has not done anywhere near as well as the US economically. And the big difference is that the US has done absolutely enormous stimulus, fiscal stimulus over the period, whereas the EU has done very little. And a reminder of the weakness of the periphery. And you'll see in the year, Italy is well down on its pre-COVID economic performance, as is Spain and as is Greece. Okay, so what is the EU's stimulus plan? Well, it's tied up with the EU budget from 21 to 27, and it's this Next Generation EU, which adds 807 billion euros to the long-term budget, adding up to 2 trillion euros. But that will be spent over the period 21 to 27. And the Next Generation EU component is in two parts. There's a recovery and resilience facility, which has grants of 338 billion. So those are gifts, except they don't need to be paid back. And then there are soft loans of 386 billion. So the recovery and resilience facility will be spent in part on COVID recovery, but also on preparing particularly the periphery nations for the energy transition. So 5G, clean tech, getting the grid in sufficient state to accept renewables, etc. And the next generation will have rural development and other stuff in it. Okay, so Next Generation EU aims: combat climate action, renewable projects, help the single market through better connectivity and digital skills. Now, one thing that is a problem with the EU's fiscal plans is that they need to be approved by the EU. So when the EU grants money to Italy, it doesn't disperse that money until Italy has presented plans showing how it's going to spend the money, and those have been approved by the EU. Now, that is a problem because the periphery nations do not have the administrative capacity to actually deal with all the paperwork, and they haven't spent all the money that has been available to them in previous years, and hence it is unlikely that they will be able to spend all this new money. Okay, so this is the Recovery and Resilience Fund as a percentage of GDP, and you can see it really matters for some of the periphery nations. Croatia, Bulgaria, and Greece all benefit by 9 to 10% as a portion of GDP. So those are big numbers, but they occur over a number of years. And if you look at the net beneficiaries, so you look at who's funding it, so that you have to issue debt to fund these payments, and who is getting the money, you'll see that the periphery nations are all big beneficiaries, and the fiscally prudent Northern European nations are all paying for it, essentially. And in absolute terms, most of the money is going to Italy and Spain, but in percentage GDP terms, obviously Greece does much better than either Italy or Spain because it's a smaller. Going back to the administrative difficulties of actually spending this money, what this chart shows is the amount of money that EU nations could spend and how much they actually did spend in the 4 years, 2017, 2018, 2019, and 2020. Now, the axes on the left, and those are dates, but they're incomprehensible. So hence I put the date on the right. So if we look at Italy in 2017, the whole of the bar is how much money it could have spent. The red bar is how much money it actually spent. So Italy and Spain, which is ES here, have only managed to spend a fraction of the EU money that they are entitled to. And that occurs in all years. Now, this shows the estimated cash flows from NextGenerationEU, and you'll see it's starting to come through in Q4 2021, and then it comes through further in 22-23 when it peaks. Now, the important thing is the size of these numbers in absolute terms for the whole of the Eurozone economy. We are talking about 150, 160 billion at the peak. When you think about the US stimulus package was 2 trillion, and then it was followed by other enormous stimulus packages. The EU stimulus package is essentially a caricature of the difference between monetary and fiscal policy, in that the reason fiscal monetary policy is preferred is that you can do it pretty much instantly. So the ECB decides it's going to cut rates, it just cuts rates. If you decide to do a fiscal package in the EU, you then need to get it ratified by 27 members, and that takes a whole year at least, and a lot of wrangling. And then when the money comes through, the crisis is largely past, and that is exactly what's going to happen. So where we are now is the treaty has finally been ratified by all 27 states, and 100 billion is due to be disbursed in the second half of 2021. But, and I don't properly understand this, but apparently the European Commission is only allowed to raise 150 billion a year. And so necessarily the money will be slowly dispersed rather than given out in one chunk as it was in the US.
That's very interesting, Keith. So that's an interesting thing there is what we're really doing is we're comparing the government stimulus in the US, which has created a massive push for economic growth, versus what's going on in the EU, which hasn't in any way kept up with it. The interesting thing is, though, that we have inflation everywhere, and it suggests, obviously we've got supply chain constraints, which are a contributor to inflation, but it suggests that the real driver for the inflation that we're seeing, assuming it's to do with government stimulus, is the US, not Europe.
Yes, no, I'd agree with that. I mean, just look at the size of the fiscal and monetary stimulus. It's just absolutely extraordinary.
Yeah.
Our next special topic, and a rabbit hole I disappeared down this week, is we are experiencing in Europe absolutely extraordinary rises in the price of natural gas. So what is a substitute for natural gas? Can you substitute coal? So this is the price of UK natural gas futures, and the UK has interconnectors with both Norway, continental Europe, and Ireland. So the UK gas price will also be a function of European gas prices, which are also spiking. And you'll see that it has gone from 37.7 in October 2020 to 140 now. So it's more than trebled. One of the causes for that is that we have stopped investing in North Sea gas production, and UK natural gas production has fallen by an enormous 28% in 2021. And everywhere we look, gas producers are under pressure to stop exploring for gas. We as a nation are disincentivizing oil and gas exploration. But this week, the wind didn't blow and there was a shortage of electricity. So we brought some old coal power plants back online. Now, the question is, if the gas price spikes later in the year, can we bring on the coal-fired power stations to compensate? So what is the relative carbon intensity of coal versus natural gas? Essentially, natural gas produces 40% of the carbon dioxide of coal. And we have here the figures of how much coal and natural gas are required to produce a kilowatt of electricity. And that allows us to do...
Sorry, I can I just interject here, because I just think that it's interesting to understand why it is that coal produces so much more carbon than natural gas per unit of energy. Mm-hmm. And on a sort of simplistic level, natural gas is one carbon atom and 4 hydrogen atoms. And when you burn it, you get 1 CO2 and 4 waters. And the creation of each water adds energy, as does the creation of the carbon dioxide. When you burn coal, which is just carbon, essentially, when you burn it, you get 1 CO2. So you get the same amount of CO2, whether you burn one of coal or one of methane. But when you burn methane, you get the additional energy of the 4 waters being produced. And that's why methane is a much cleaner, less carbon dioxide creating fuel.
Yes, absolutely. Thank you, Richard. So when comparing the cost of coal and natural gas, we have to take in EU carbon tax, essentially. And so you can work out from the relative carbon intensity of coal and natural gas and the current EU carbon price of 60 euros per tonne, the cost of producing a kilowatt of electricity for the two. And it's quite substantial, actually. So last year, the average UK electricity price per kilowatt hour was 14.4p. Now, the carbon tax for coal production of 1 kilowatt hour would be 5.6p, or 40% of the end price. So coal would have to be really very cheap in order to produce electricity economically at that price, because the price available to you would only be 9p per kilowatt hour after taking off the tax, and then you have transmission, etc., etc. Whereas for natural gas, the carbon tax is only 2.3p, but that again is substantial. That's 15.5% of the end price. Now, if we then do a calculation on the relative cost of producing electricity from coal and natural gas, you get to essentially very similar prices after accounting for the carbon tax. The bottom line is, if natural gas prices spike, then coal is not a cheaper substitute at the moment, because the coal price has gone through the roof as well. So it looks like unless we get a big increase in natural gas supplies, then you could see sustained rises in electricity prices.
There is going to be pushback against the carbon emissions price, because it's going to start contributing to a sort of distortion of the energy market, but also to contributing to the inflation. And I correct me if I'm wrong, but basically the cost of the carbon permit ends up in government coffers ultimately. Yes. So it is an additional tax on energy, and with energy price going up and the tax going up the tax also on an accelerating path under the current regime, at some point the system is probably going to break.
Well, the other thing, Richard, is the narrative is currently all about global warming and climate change. Yeah. But at some stage, as electricity and heating prices go through the roof, the narrative could well change to one about social justice. And we're just going to have to wait and see what happens. But we have talked about the European carbon trading scheme several times on the weekly. And I think the cuts in the number of certificates this year, which we've talked about will lead to a spike in the carbon price, is going to disadvantage European industry to far too great extent. And I just don't think it's politically viable.
It's going to have to be changed to some extent. And this is an interesting point. We don't want to spend too long on this, but I often, the economy is a complex system with emergent properties, and regulators frequently do things without thinking that if I do A, then B will occur. We've been through a pandemic where we actually really don't know what the emergence will be from the pandemic. And it's very difficult for regulators to do their simple equalities with any degree of certainty.
Yeah, I agree. So in summary, unless we get a lot of extra gas supply from Russia, then I think we're in for a difficult winter potentially in terms of electricity and gas prices.
That's very interesting, Keith. Thank you very much for that commentary. Oh gosh, look at that spike.
Yeah, this is UK electricity prices. And German 1 year ahead electricity prices. This is 1 year ahead. Yeah, this is not spot. So we're looking now at sustained rises in electricity prices because of a sustained shortage in natural gas. And if you look at this chart, so this is German 1 year ahead electricity prices, you'll see it had a low of below 30 euros per megawatt hour and has spiked to above 90. Well, this is yesterday, and prices were 138 in Germany. So that's 50% above this spike. Okay, moving on to other charts. Do you want to talk through this, Richard?
Yes, Keith. So the global credit impulse is fading. So this is a chart which is linking the Bloomberg Commodity Index to the credit impulse. And as we know, the credit impulse in 2020 was enormous. And bearing in mind that this is a year-on-year change chart. And the suggestion here is that the commodity index will drop in accordance with the fact that the credit impulse is year-on-year. Is actually, there is tapering, isn't there, Keith? Is that how I got that right?
Yes.
Yes. So they're suggesting that the commodity boom is over, in fact. What do you think, Keith?
Frankly, I think this is an absolutely idiotic chart, and we like Nordea normally, but I have big problems with this because essentially we had this enormous stimulus last year. And if you were to keep on printing money, and last week we showed the chart of US M1, which is going through the roof, and there was a 30% increase in the money supply last year. If you were to keep on printing money at that rate, because this is an annual change, the blue line, which is the credit impulse, would slowly decline to zero. And presumably, according to this chart, then the commodity index would decline with it. Whereas, and you're printing money like mad, and you would get inflation, in which case the commodity price would go through the roof.
Yeah.
So according to Nordea, the only way to keep the commodity price up would be to have accelerating money printing in order to keep the blue line up. And only then could you get the commodity price to continue to be high. It's just,
yeah, I mean, it's one of these spurious correlations, I think, isn't it, Keith? And in fact, the correlation from 2011 up until 2020 wasn't great at all.
Yeah.
I don't know what the correlation coefficient would have been, but it's not high at all. There is suddenly a correlation in the middle of 2020, but that doesn't mean that the correlation is genuine, nor does it mean it will continue.
Precisely. But this is a chart that's absolutely loved of the bears. You see it, all over Twitter, and it's just silly.
Sell your commodities, or don't.
But a reminder that central banks everywhere are still printing money.
And everybody knows our Keith and my views on whether central banks will actually be able to taper in reality over a protracted period of time.
And the economy is just doing amazingly well. These are job openings, as we've covered. What are they doing printing money? The economy doesn't need it. It needs people to go back to work.
So this is a letter to the FT that we spotted a few days ago, and to our minds, he specifies the problem really precisely, and it couldn't be phrased better. So we're not going to read it out, but we recommend you spend a minute or two just reading through this because we think it's great.
Now, on to the US jobs report for August, which was a huge disappointment. But essentially, if you look bottom left at the table, you'll see that there was a drop in employment in the retail trade because of the Delta virus, and that leisure and hospitality did not grow at all. And I think that's all just temporary disruptions, essentially. Now, the other thing that is going on in the world, and frankly is concerning, is that finally, after many years talking about excessive credit growth in China, we are starting to see problems emerging. Now, this is the price of various Evergrande bonds. And Evergrande is the largest property developer in the world. And you will remember that some years ago, it sold $10 billion worth of dollar bonds, and their price is collapsing. And if you look at it another way, that means their yield has gone through the roof, and some Evergrande bonds are now yielding over 100%.
I'm minded, Keith, of the ghost cities of China. And I'm guessing Evergrande owns a chunk of some of those. And the perception, probably, if my memory serves me correctly, 8 years ago maybe, was that the property market in China was heading for a huge bust because the building was being done on an entirely speculative basis. There was no rental income. People were buying them as a speculation that the asset price would rise. And you do wonder whether the chickens are coming home to roost somewhat belatedly as support from the Chinese government or central bank via credit creation is removed.
I think you're absolutely right, Richard, because the thing is, when we talked about it years and years ago, you know it can't carry on forever, but you just don't know when. And I think when may finally have arrived.
And then the question is, what will they do about it?
Absolutely. The other thing I wanted to talk about was everyone talks about how smart bond investors are. And if you look at this chart, between like the mid 2020 and mid 21, the price of Evergrande bonds fell and they were quite subdued. Whereas I remember when Evergrande was raising money in international markets, thinking you would have to be a total idiot to buy these things, because that Evergrande has vast amounts of Chinese debt. It's opaque. And why is it going to international markets? Is presumably because they're struggling to fund themselves. What this shows is that bond markets have a very short-term focus, because medium term, Evergrande was not a good bet. But as long as it, in the short term was paying its interest rates, nobody seemed to care.
I couldn't agree with you more, Keith. I think it may well have been true before massive central bank intervention in the bond markets or in credit creation. The bond market may well have been a very good predictor of the future. I'm not saying it was, but I think now, the whole world is so topsy-turvy. People are so desperate to chase yield that I don't think the bond market is a good predictor of anything other than what people think the central bank is going to do, and or the drive to get some yield anywhere. And this chart is an indication that people were desperate for yield.
Yeah, very good point, Richard. So this chart from the FT showing global equity exposure to China and Hong Kong, and the FT is saying that international investors are fleeing. Although, of course, the Chinese index has come down, so it naturally would have fallen as a percentage of people's portfolios anyway.
Good point, Keith.
And this is the European high yield bond real yield. And you'll see it's down to about 0.5%, which is just, so you're saying that these small speculative companies in Europe, you're willing to lend to them at inflation plus 0.5% is absolutely extraordinary. And long term, that can't be a good rate.
We also, cynically, he says, we also have it, real yield is central bank measured inflation as opposed to what we suspect real inflation is.
And as a consequence of the problems with Evergrande and other financial institutions in China, you're seeing credit conditions tightening.
This is quite dangerous for China.
It is. And you see how quickly this has moved.
Yeah. And if you consider that a lot of Chinese companies, state-owned enterprises and private companies are very highly indebted, not just Evergrande. And if the yield, the index has gone up by 4 or 5% in the last 2 months, 3 months, then that is hugely damaging to highly indebted businesses.
Well, it'd be interesting to see how they deal with this, because the danger is they allow the yuan to devalue, and essentially they export their problems by essentially they try and increase their exports to get foreign capital in.
Yeah, yes, that's true, and that would be very unwelcome elsewhere.
Precisely. Okay, now this is an interesting chart from Yardini Research, actually, not from John Authors, and it shows the effective tax rates on the S&P 500 and how they have fallen over time. Now, in the UK and elsewhere, we are now seeing tax rises to pay in part for the extraordinary stimulus we had over the last year and get fiscal sustainability back on track. And you have to wonder whether the extraordinary tax cuts we have seen, both in statutory terms and in real terms in the US, will start to be unwound now. And in the UK, and actually, frankly, everywhere, we're seeing enormous supply chain disruption. In waterborne freight from China, we know is at all-time high prices. And then within countries, most nations appear to be struggling to recruit enough truck drivers. And so this is how it's starting to have real effects on the economy.
This is interesting, Keith, as well, because it's showing that both subcontractor rates and input prices are higher than they have been for, 20 years, and we don't know how much further back. This is a huge change from if you want to call it the status quo of the last 2 decades.
But don't you know, Richard, that everything's transient? No, this isn't going to be inflationary.
Well, we had a transient period of subcontractor rates being relatively stable, Keith, between 2001 and 2020.
Yeah.
I'm not even sure whether the use of the word transient is correct. I mean, I believe the word is transitory myself, but
Right. Yes. No, I was using the word transient. I think everyone else used the word transitory. So the same as in the EU, manufacturers reporting they can't get enough material and equipment. Actually, moving on to an entirely different subject. So the UK has now passed this bill raising the tax on national insurance, which is paid by everyone, including people who are not caught by the income tax net. Is that correct, Richard?
No, it's paid mostly by I can't remember the exact figures, but it's basically paid mostly by people who are in an income bracket of 10,000 to 55,000, something of that nature.
Right.
It's not paid by pensioners, and it's not paid on capital gains or dividends.
But what I find interesting about this is that all the data shows that actually the elderly have really very substantial assets, mainly in the form of housing. So 25% of people aged 65 plus are living in households with a household wealth of above £1 million. So essentially what the UK government has done is that it has passed legislation which will make young workers pay for the social care of quite wealthy elderly households who could easily pay for it themselves. Now, I don't want to get into the morality of all this, but what I find really interesting is if you just think of the generational warfare, and as the UK population ages, and in fact, all democratic populations are aging, they will tend to vote for the government that will best look after their own interests. So it will vote in a government that will pass legislation to the benefit of the elderly at the expense of the young. And I think this is a very good example of that.
Well, it's the young pay for the elderly's pensions, the elderly's care, and they pay for their own education, whereas the elderly had their own education paid for by the generation prior to them. So we've switched it around now. So we're basically saying young pay for everything, the elderly get everything for free, and it's totally iniquitous. And anyone who has children who are sort of at the start of their careers, I think feels very sorry for their children because they are exposed to this massive liability, and they are being, in my view, they are being abused by the system. And I think I will get into the morality of it because I feel very strongly about this. I think it is wrong. I think it's fundamentally divisive of society.
I completely agree with you, Richard, but we are now going to get letters.
I'm going to calm down. I'm just going to have a glass of water, Keith.
Which is the reason I didn't want to go into it in the first place. But anyway, moving on. Right, so moving on to the checklist. The equity markets had generally a poor week after the US payroll numbers upset them slightly. So FTSE was down 1.6, stocks Europe was down 1.3, S&P 500 was down, my God, by 1%. The NASDAQ was down 0.5%.
I think Janet Yellen was on holiday last week, Keith.
Right, yeah, so she'll be back this week and it'll shoot up again. Right. Now, in Japan, there was a change of government and the market is shooting up 3.8%. Bitcoin had a bad week, down 6.4%, and Richard will talk about that shortly, and sterling drifted up. Now, this is the PE ratio of the S&P 500, and it is just shooting up. So a lot of the fact the rise in the market is just caused by PE ratio expansion. How long can this continue? Yeah. But the punters are buying into the equity market in absolute record flows. So the green line is 2021. The last record was 2017. It's just extraordinary.
So people are putting their savings into the equity markets, aren't they?
Yeah. Well, you're not going to keep it in the bank, you know. So basically, punters on, seeing that real rates are essentially zero in their accounts. Well, rates are zero in their accounts, and inflation is picking up. Quite rationally, they're trying to buy inflation-protected assets.
Although we will just refer back to previous podcast, Keith, where we have queried how inflation-protected stocks are once the inflation rate gets up above about 5%.
Absolutely. And also it depends on what you buy. If you buy the FANGs and interest rates start rising, I'd expect those long duration assets to get destroyed.
Yes. Good point, Keith.
Now, as we just covered, Japan had a good week, but equities are not necessarily a great investment all the time. So this is the relative performance of Japan after bursting its bubble relative to the S&P 500. And you can see that it has fallen by, what's that? 92%, 93%. Amazing. Richard.
Thanks, Keith. So Bitcoin chart, it had a bit of a Bitcoin and Ether both dropped last week. I actually don't know why. There's been a lot of toing and froing with the SEC saying they don't like some of the Bitcoin exchanges, the way they want to regulate things more and so forth. I don't know if there's any specific. Oh, and El Salvador could you introduce Bitcoin as a national currency, didn't they? So I don't know why we've had these big falls. Other people may know, but on Ether we can see the same thing happen on Ether. And Ether's fall actually was quite a lot bigger because it was down 15% at one point, I think. And then I put in the log chart of Ether, which people know I like to do, and the price is still very well clear of the log chart line for Ether. So, then on the next slide, I picked out from today's FT, actually, a couple of article headlines. So NFT, that's non-fungible token mania, shows races on to dominate space in the metaverse. Metaverse being the virtual universe that you can join by using various software. The NFTs, non-fungible tokens, as I explained last week, very superficially, use Ether in order to enable the trading of non-fungible tokens. And MasterCard buys blockchain analytics startup, which means that MasterCard is very interested in not missing out on the blockchain space.
Okay, on to industrial commodities. And
Keith, I should say, Keith is not convinced. and I think he is thinking, what a load of ... when considering the word metaverse.
Yeah, I am actually, yes. That's because I am above the age of 12. Right, so anyway, moving on. It was a mixed and volatile week with some big movements. So aluminium was up 4.5%, cobalt ticked up 0.8%, copper up 0.1%, chromium up 2.5%, which is interesting because the main use of chromium is in the steel industry. And iron ore was moving in the opposite direction, down a massive 11%. And we had previously flagged that the mandated falls in steel mill production in China in H2 would have a knock-on effect in the iron ore market, and we don't know how low iron ore will go. Lithium was flat, neodymium was flat, nickel was up 4.5%, and we'll show you a chart shortly. Ferrovanadium fell in line with iron ore, so it was down 2.6%. WTI was down 1.7%, which is slightly surprising given the disruptions caused by Hurricane Ida. European natural gas had an absolutely extraordinary week, up 9.3%. Coal was flat at massive highs. We'll show you a chart. And uranium had another great week. So this is crude oil chart. Now China has released stocks from its strategic reserve in order to dampen domestic oil price inflation. And this is the timeline of OPEC cuts. And bear in mind, we're now in September, and OPEC are agreeing to increase production by 400,000 barrels a month until mid next year, when production will normalize. And they are forecasting that the market will move strongly into surplus next year. And if you're an oil bull, you must be skeptical of this chart. And frankly, I am. I think that we've got lots of constraints on supply, and OPEC have never been very good at forecasting demand. But certainly the market will be swinging more into balance next year on increased OPEC demand, unless the world economy normalizes and people get back to flying. And just a reminder, we are currently experiencing the blue line, which is OEC commercial stocks, and the pink line, and what would happen to stocks if OPEC opened the taps. So currently, OPEC have a lot of spare capacity that the world economy is not able to absorb. And if they open the taps, the price would collapse. But one of the things about OPEC and OPEC Plus is that the production quota you get is a function of the maximum production you declare that you are capable of. So everyone has an incentive to try and claim that their production is very high.
Yeah.
And last month, the production quotas rose for Russia and all the other nations, but actually Russian exports fell, and they fell quite substantially. They fell by 300,000 barrels a day. Now, if Russia has the 1 million barrels a day of spare capacity that it claims, why did its exports fall? It could just have drawn on its excess capacity and filled the gap. So interesting. Perhaps all the spare capacity isn't really there.
Yeah, that's a very interesting point, Keith.
Now, US oil consumption, we know that people are still not flying properly in the US, but US oil consumption is actually back to its 5-year average.
I think people are driving a lot more. In the UK, I read yesterday that train journeys are 30% of what they were pre-COVID, and driving is back to pre-COVID levels. And of course, driving is far more inefficient in use of fossil fuels than a train journey is. So that will have made a big difference to the oil consumption versus activity.
Absolutely, Richard. And the other thing that people don't talk about is petrochemical demand. Because as we have seen this spike in goods consumption, so you need to consume more oil to make more plastic.
Good point.
And these are US oil inventories. And you can see, if you look at bottom right, total inventories are the lowest they have been in 5 years at this time of year. Okay, moving on to aluminium, Richard.
So thanks, Keith. So I think we talked last week about how the aluminium price has been affected by China reducing its smelting because it wanted to use the energy for other purposes. But this week we had a military coup in Guinea, and Guinea produces 25% of world bauxite production. And this has clearly spooked the markets because they're wondering whether 25% or some chunk of it is going to go off the market, which would have a dramatic tightening effect on the aluminium market. Copper is basically trading at a range now, has been for the last 2 months. Chromium is bouncing around quite violently, I would say, plus or minus 30%, 40%, 30%, but not really going anywhere over a period of time.
Yeah, I'm puzzled by the rise in chromium, frankly, because if Chinese steel production's going down, surely they need less chromium. Shouldn't the chromium price be going down?
Well, I suppose it depends on steel production. Basically, you're producing iron with a specific amount of carbon in, aren't you, to produce steel? And then you take your steel and you produce specialist steels like chromium steel and vanadium steel and so forth. So it may be that the specialist steels are either the same or going up.
Okay.
You don't look convinced, Keith.
No.
It's I wouldn't say I was an expert. I just see you're thinking that as well. Iron ore going back down to zero, isn't it? Go back down to where it was 9 months ago. I think at the time we all wondered why the price of iron ore was going up because there was no shortage.
Yeah.
And now it would appear it was going up because people were speculating in it.
Well, I think the massive rise in demand and supply, we know there's a lot of supply chain disruption in the world. And now the Chinese have mandated cuts in steel production. It's, you're still producing lots of iron ore, and one of the main buyers has cut its demand.
Yeah. Presumably it'll have an impact on supply in due course and the price will stabilize. Yeah.
Well, I don't know, but we don't when you look at this chart, you've got no idea where it's going to bottom.
Nickel is on a nice steady upward trend. Keith was pointing out, I'll steal his thunder here, that we believe that, genuinely believe that nickel is actually in surplus at the moment. Yet it is the price is going up in a nice trend channel, But Keith has found this chart which shows that nickel inventories are falling, which means nickel can't be in surplus, it must be in deficit.
Yes, absolutely. So the commentary I previously read could well just be wrong.
Interesting. Price of tin went up very, very sharply. And now it seems to be leveling off at the moment, which remains to be seen. As Keith said last week, tin is widely used in electronics as a solder, I think, isn't it, Keith?
Yeah, at these prices, you've got to think they're going to be trying to thrift it to substitute it for something else.
Yeah. Ferrovanadium coming off a little bit.
You see, this is the chart pattern I expect, Richard. Iron's coming off, ferrovanadium is coming off.
Yeah. And as Keith has discussed at length previously, UK natural gas price, the Dutch natural gas price, one year price is frighteningly going up, I would say, in terms of the impact it's going to have on our economies.
Yeah. Now, Nord Stream 2 should come online late in the year, but you're looking at a gas crunch in Europe.
Yeah. Coal price continuing to rise, didn't do very much this week, but it is so far sustaining the meteoric tripling that it's experienced in the last 14 months.
Okay, now talking about coal and coal demand, this is global electricity generation from coal, and it shows that last year was a good year, and actually we were 6% below the 2018 peak in terms of coal generation. So that is mildly encouraging, but it really is a tale of two halves in that all the growth in coal generation is in Asia. Everywhere else, so Central and South America have actually massively cut their coal-fired power stations over the course of the last decade. I mean, that's very encouraging. And Europe the same, but it's been more than compensated for by coal generation in Asia. And if we look at global power generation, so the bar far left is total power generation in 2009, and bar far right is in 2019, and the bars in between are how you get from 2009 to 2019. And so you'll see the majority of the new power generation over the last decade was in gas and coal, then followed by wind, hydro, and solar. There was very little nuclear, and we actually cut oil. But if you look at China, you'll see that over half of new power generation was from coal. And then there was, I take it that's the Three Gorges Dam.
Yeah.
A massive increase in hydro, and then actually a decent increase in wind and nuclear. But India is frankly depressing. That's something like 80% coal. North America is very interesting because you added gas and wind and you took away coal, but almost perfectly substituted gas for coal.
Can I just make an interesting observation, I think, on both Europe and North America, is that the energy consumption over the last decade up to within this period was almost unchanged, which suggests that once an economy gets to a certain level of development and sophistication, the energy savings through increased efficiency are offset the energy increases through growth of GDP.
Yes, absolutely, Richard. In Europe, not only was there very little change in electricity generation, as Richard has pointed out, but also we added renewables, so wind the most, then solar, then other, and that would be biomass and other stuff, and hydro, and then we cut oil, gas, nuclear, and massively coal. So that is very good. The energy transition is occurring in Europe at least, and also partly in the US, where we've substituted lower CO2 emitting natural gas for coal.
Price of uranium we commented on last week continued to go up this week. Reading in the FT today that we had an article on it, basically considering that private individuals and investors buying uranium and squeezing the market. Well, now that I'm back into uranium, long may they continue to do so.
Yeah. Well, the thing is, Richard, I'd like to see industrial consumers like nuclear power stations squeezing the price up rather than the Richard Wheaters of this world.
Precious
Okay.
metal.
Yeah.
So a pretty quiet week for gold and silver. Platinum, a fairly large drop. Rhodium, a big drop. And palladium, a massive drop. So an unusual grid for precious metal prices, I would say, this week.
Well, during the week, we did an update on Sylvania Platinum, where we talked about global emissions standards and the fact that global car makers have cut production currently, while the supply of PGMs is actually above normal because of the Amplatz converter plant coming back online and working through a backlog of semi-processed material.
The rhodium chart, it looks like the iron ore chart, Keith.
Yeah, you just don't know how low this is going to go, unfortunately.
No. Actually, the palladium chart looks very similar. I mean, not to such a percentage scale. And it's now dropped to the bottom of where it's been in its range from last year.
Okay, moving on to rates, and we had a small rise in the UK yields across the curve last week. In Europe, we had a rise in Greek 10 years, but a fall in Italian and Spanish. And if we look at the spread of Greek 10 years over German 10 years, they actually fell. And that is because German 10 years had a bit of a spike. So you wonder whether European bond investors are finally becoming slightly concerned about inflation and the reduction in the ECB's bond buying program.
Yeah.
Onto the seasonality chart, we are approaching the late September doldrums. You heard it here first. Right, Richard, do you want to talk through your activity this week?
I will do. Thank you, Keith. So my weekly update, I had a modest week. I was up 1% on the week. This was pretty much entirely due to my holding of Colonial Coal, which is up 60% this week.
Wow.
There are no news announcements, frustratingly. And I haven't been onto the chat rooms to find out, because frankly, I find the chat rooms quite tedious on the whole. I'm sorry, that's probably an iconoclastic statement to make here. So I actually don't know why they have suddenly surged. But anyway, it had a significant impact on my whole portfolio because it's such a large change. And no purchases and no sales. And I'm pleased with myself because I like to run a stable, inactive portfolio. And over the last few weeks, I have generally succeeded in doing that.
Very good.
Keith.
Thank you, Richard. Well, I am both more active than you and seriously underperforming you. So I had another poor week, although I did actually manage to outperform the all share for once. So I lost 1.4% on the week. That takes me down to plus 2.2% on the year, massively underperforming Richard, Stuart, and the all share, which is rather annoying. And I sold some Pharos Energy, which I also sold last week. I liquidated my position in HSBC, which I bought the banks earlier in the year because I expected interest rates to rise, and that's be good for the banks. And that has worked for Lloyds, Barclays, NatWest, and the UK banks. But it's I sold Standard Chartered because it fell, and HSBC. Frankly, I bought it because I had this macro view, but I was concerned about China. Now, it only has about 2% of the loan book on mainland China. But the reality is, if credit conditions are tightening in China, they're going to tighten in Hong Kong. And I was down, the price has been drifting off, and I thought, get out. And I also sold a bit of Enquest because the gas price is rising and I want to buy some UK gas producers. So I bought some Serica Energy and I produced a spreadsheet looking through the forecast production for Serica Energy. And frankly, UK gas price is currently 140p a therm. I put in a price of 100p a therm and you get P ratio of Serica Energy of less than 2. So if gas prices stay high, then these two, Serica and Independent, should both do well. Now, the other companies that I own that had interesting weeks, well, Hard-Eyed is a tiny UK industrial company that does tungsten carbide and tungsten coatings. So they harden bits of machinery, essentially, and they got their first contract from a global gas turbine manufacturer, and the shares are incredibly liquid and they promptly jumped 30%. But I think this is a long-term holding for me. I think this is an interesting company. I've got a very small amount. They're very illiquid, and it's a growth story. Now, Excelsior Mining, which we have done a share talk on, have had recent update in which they claim they have a solution to their calcite problem.
Right.
However, we await the technical report, and they are saying that, as we expected, production from Gunnison will be slower than expected, and they're going to reopen a nearby open pit mine to provide copper to compensate for the slow opening of Gunnison. However,
so in fact, Keith, the solution is to dig the stuff up.
Yes. Well, let's wait and see what the technical report says. But the market actually did not have a good day on the back of this technical update. So wait and see. Now, Independent Oil and Gas, which I bought, it has first gas in Q4, we hope, and will be selling into an extraordinarily elevated gas price. Now, this is HSBC, which I have cut and has been disappointing. I bought it back here and was briefly up, and it's drifted off. And this is Serica Energy, which I have bought substantially more of. I bought an initial stake right back here, but I've added substantially to it in the last few weeks.
Well done.
And I think that is it for this week. Thank you all for watching and making it through to the end. Please, can you press like and subscribe to the channel? And in the meantime, it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.